You've got a brilliant idea. You spend countless sleepless nights working tirelessly to build your product, convincing your very first customers. Then one day, you meet an investor willing to put money in and turn your dream into reality. But right at that moment, a thick stack of papers lands on the table, full of terms, clauses, and fine print. You nod and think only one thing: I need the money. I'll sign. Fast forward a few years and you realize you now own only a tiny slice of the very company you built. The big decisions are no longer yours to make. You've become an employee in the business that was supposed to be yours. This is the painful reality thousands of founders in the US have faced, not because they lacked passion or talent, but simply because they didn't understand the rules of the game when they stepped in. Brad Feld and Jason Mendelson wrote Venture Deals to change that. They don't want you to be the founder who loses everything because of one rushed signature. They want you to walk into negotiations with confidence, to know the rules, and to stay at the helm of your own ship. If you're a startup founder, if you're raising capital but still want to preserve the soul of your company, this book is your map. And if you want to keep discovering books that can save you from costly mistakes, make sure to hit like, subscribe, and follow today. Part 1. What venture capital is and how it works. To understand venture deals, we first need to understand venture capital. It may sound complicated, but think of it this way. There's a group of wealthy individuals or large funds who pool their money together to invest in young companies with big potential. They know most of these companies will fail, but if just a few hit it big, the returns can be hundreds of times what they lost. Unlike banks, which only lend when you have collateral and steady cash flow, venture capital is all about risk. To them, a bold idea can be worth more than any physical asset. Instead of monthly interest payments, they want equity. They want a piece of the company because they believe its future value could multiply many times over. Let's make this real. In 2004, a young guy named Mark Zuckerberg needed funding to grow his tiny social network. Peter Thiel, a venture capitalist, invested $500,000 for 10% of Facebook. Today, that investment is worth billions. That's the essence of venture capital, a high-stakes bet where one good decision can literally change history. Or take Amazon. Jeff Bezos started with a small warehouse selling books online. Early venture capital funding didn't just help him survive, it fueled Amazon's global expansion. Without it, Amazon might have stayed just a small online bookstore. For startups, this relationship is like rocket fuel. You may have the blueprint and the crew, but without fuel, the rocket never leaves the launch pad. Venture capital is that fuel. But here's the catch. When you take the money, you're also inviting investors on the ship, and they get a say in where it goes. In other words, venture capital is the bloodline of bold, risky ideas. It's what turned projects like Google, Facebook, and Amazon into giants. But it also reminds you, raising capital isn't just about getting money. It's about sharing ownership and control with those willing to bet on your dream. Part 2. The term sheet. Key clauses you must know. When a venture capitalist agrees to invest in your company, they don't just hand over a check and shake your hand. Instead, there's a document called a term sheet. It may sound dry, but in reality, it's the roadmap that defines your relationship with them for years to come. Think of a term sheet like a prenuptial agreement. It clearly spells out who owns what, who gets to make which decisions, and what happens if the relationship breaks down, whether that means the company is sold or worse, goes bankrupt. There are a few critical clauses every founder must understand. First, valuation. This is how both sides agree on what your company is worth before and after investment. For example, if your company is valued at $4 million pre-investment and an investor puts in $1 million, the post-money valuation becomes $5 million. That means the investor now owns 20% of the company. It's simple math, but it determines how much of the cake you actually get to keep. Next, liquidation preference. Strange term, but here's the idea. If the company is sold or shut down, investors get their money back first. Imagine you and your investor open a restaurant together. If one day the restaurant has to liquidate its assets, the investor takes back what they put in before you get anything. This ensures they don't walk away empty-handed. Then there's anti-dilution. Startups often raise money in multiple rounds. The problem? If your company is valued lower in a future round, earlier investors' shares lose value. To protect themselves, investors often demand anti-dilution provisions. For founders, this can mean your slice of the pie shrinks over time if you don't grow as expected. These clauses aren't just legal fine print. They directly affect whether you remain the captain of your startup or just a passenger. Here's a real-world example. Many young founders in Silicon Valley have signed term sheets they didn't fully understand. When their companies were sold, investors walked away with all their money back plus profits, while the founders, who had poured in years of sweat and sacrifice, were left with only a tiny fraction. That's the price of ignoring the small print. So remember, a term sheet isn't just paperwork, it's the rule book for the entire journey. If you don't read carefully and truly understand it, you might be giving away far more than you realize.
Part 3. Power and control after raising capital. When you take money from a venture capital firm, you're not just selling equity, you're also giving up a share of control. And this is something many young founders overlook until it's too late. One of the main tools of control is the board of directors. Think of it as a group sitting in the driver's seat with you, and sometimes they can grab the wheel. After a funding round, investors often demand one or more board seats. That means big decisions like hiring a new CEO, changing strategy, or even selling the company aren't yours alone anymore. Then there are special veto rights. Many investors require that certain actions can't happen without their approval. Things like taking on new debt, issuing more shares, or merging with another company. On paper, these clauses are framed as protecting everyone's interests, but in practice, they can leave founders handcuffed. Here's a simple example. Imagine you start a coffee shop chain and a VC invests. Business is going well, and you want to open a new location in a busy neighborhood. But then you discover that under the agreement, you can't expand without board approval. And on that board, the investor holds a key vote. If they think the timing isn't right, you're stuck waiting while opportunity passes you by. This has happened time and again in big tech companies. Many founders have been pushed out of their own startups not because they lost passion, but because control shifted to the board, where investors had the louder voice. Brad Feld and Jason Mendelson want founders to understand this. Raising capital isn't just about the money. It's about sharing power. You need to negotiate carefully to make sure your voice still matters. Otherwise, one day you may wake up to realize the company still carries your name, but you've become little more than an employee working for those who wrote the checks. Part 4. The art of negotiation. Not win-lose, but win-win. When people hear the word negotiation, they often picture one side pounding the table while the other side tenses up, each trying to squeeze out the biggest advantage. But in venture capital, Brad Feld and Jason Mendelson emphasize this. If you walk into the room with the win-lose mindset, both sides will end up exhausted, and ultimately, your company will be the one that truly loses. Why? Because raising capital isn't a short-term transaction. It's more like a marriage. When you accept an investor's money, they're joining you for years. They bring not only capital, but also advice, networks, and sometimes pressure. If from day one they feel they've been taken advantage of, the relationship will always be strained. That's why negotiation in a venture deal must aim for balance. Investors want to protect their money. You want to protect your vision and your ability to run the company. A good term sheet is one where both sides leave the table feeling respected and motivated to help the company grow. Here's an example. Imagine you're building a software company. An investor demands a 3x liquidation preference, meaning if the company sells, they get $15 million back on a $5 million investment before you see a single dollar. That's heavy. Instead of reacting harshly, you could negotiate it down to a 1x preference. They get back exactly what they put in before sharing the rest. In return, you agree to give them a seat on the board. The result? The investor feels protected and you still keep most of the control. In other words, negotiation isn't about grabbing the whole pie. It's about baking a bigger one together. If you only chase a short-term win, you risk eroding trust and your company's long-term growth will suffer. Always remember, a good deal isn't one where you beat the other side. It's one where both sides walk away smiling, ready to roll up their sleeves and build the future together.
Part 5. The role of lawyers and advisors. In the startup world, a common mistake founders make is underestimating the role of lawyers and advisors when signing investment contracts. Many think, I just need the money, let's sign the legal papers quickly and move on. But Brad Feld and Jason Mendelson warn, it's exactly those pages full of fine print that determine whether you'll still own your company or lose it. A good lawyer in a venture deal doesn't just read the contract. They're like radar, spotting hidden traps buried in the text. A clause that seems harmless could strip you of veto rights or leave you with almost nothing if the company is sold. Think of it this way. You may have the money to buy land, but if you don't hire an architect to design your house, you might end up with weak foundations, cracked walls, or a structure that can't be expanded. Fixing it later will cost far more. Venture deals work the same way. You might raise money, but without a lawyer guiding you from the start, the legal foundation of your company may be shaky and full of risk. There are painful, real-world examples in the US. A group of founders in Boston once skipped hiring a venture lawyer to save a few tens of thousands of dollars. They signed a contract with an extremely unfavorable liquidation preference. When the company was sold, they expected millions, but each founder walked away with only a few $100,000, while investors pocketed most of the profits, all because no one carefully reviewed the contract. And it's not just lawyers, advisors matter too. They might be experienced entrepreneurs or people who've been in your exact shoes. They know which terms are worth fighting for, which ones you can concede, and how to negotiate in a way that protects your vision while giving investors peace of mind. Brad and Jason drive the point home. Cutting back on legal costs in a multi-million-dollar deal is like buying land worth millions but refusing to pay for an architect. You think you're saving money, but in reality, you're multiplying your risks. In short, lawyers and advisors aren't expenses. They're investments. Investments that protect you, protect your company, and protect the dream you've worked so hard to build. Part 6. Culture and the founder-investor relationship. Money matters, but in an investment deal, money is only half the story. Brad Feld and Jason Mendelson emphasize that what truly determines long-term success is the relationship between the founder and the investor. You might raise millions to build your company, but if you choose the wrong partner, you're stepping into a risky marriage. A venture capital firm doesn't just bring money, they bring culture, expectations, and their own vision for how you should run the company. If that culture doesn't align with yours, conflict is inevitable. Imagine you open a family-style restaurant focused on quality dishes and loyal customers. But your investor only cares about rapid expansion, cutting costs, and flipping the business in a few years. You're following two different maps, and soon the company's car will be pulled in opposite directions. Take the case of a tech startup in California. The founder was passionate about building tools to support teachers and communities, but their investor only thought about scaling fast to sell to Google or Amazon. The constant pressure to grow quickly stripped the product of its original care and quality. Employees lost motivation, and the founder felt they had abandoned their ideals. They had money, but they lost the soul of the company. Brad and Jason compare the founder-investor relationship to marriage. This isn't a short fling. It can last 5, 10, or more years. That's why you must take the time to truly understand who you're saying yes to. Meet them, talk to them, and see if they understand you, share your values, and will stand by you when times get tough. In a successful deal, investors don't just provide capital, they open networks, connect you to key customers, partners, and mentors. They act like seasoned teammates, ready to step in when you hit a crisis. But in a bad deal, investors can become your biggest source of pressure, forcing you to chase goals that don't align with who you are. The lesson is clear. Choosing an investor isn't just choosing money. It's choosing a partner. If your cultures don't align, no matter how many millions hit your bank account, you can still lose your company and the dream that started it all. Starting a company is a tough journey. You pour your heart into building something meaningful, a product or a service you believe can change people's lives. But once you step into the world of fundraising, many founders lose control simply because they don't understand the rules of the game. Venture Deals by Brad Feld and Jason Mendelson is the guidebook to keep you from making that mistake. It's not just about terms, numbers, or legal documents.
It's about power, fairness, and above all, holding on to your dream. If there's one lesson to take away, it's this: money is never just money. It always comes with conditions, relationships, and influence over your company's future. Once you understand the game, you stop being the one asking for help. You become a true negotiator, firmly steering the wheel of your startup. And if you want to keep equipping yourself with the mindset, tools, and lessons to master money, launch smarter startups, and invest wisely, don't forget to like this video, subscribe to the channel, and follow today. Because sometimes the right book at the right time can change not just your business, but your entire life.